So let's talk about options, first beginning with the definition of what they are. They are the right, but not the obligation to enjoy profit from something. And as they are a derivative, they are linked to some sort of underlying security. Taking an example, an option on an equity, they have options on many things besides equities, but equities are the most common. We will have something called a strike price, and that's the rate at which an option can be converted to shares. More generally, it's the rate at which you can exchange an option for the underlying, whatever the option is on. So for an example, if we have a strike price, let's call strike X here, of $50 for share A, and that means that I have an option. If this option has a strike price of X, I can convert this option into one share, and it's worth $50 a share. And that's great, because if the share is currently worth $60, then this option gives me the right to convert for $50, and I could immediately take that converted amount and sell it for $60 for a $10 profit. And so with this example, that's why a payoff to an option, part of it, this is a call option, by the way, is the difference between the underlying, the spot, oftentimes we just call that S, and the strike. What you saw here, that was the X. That's this $60, that's what the underlying is, or oftentimes we'll use the word spot, and the strike, many different strike prices for a single underlying equity. In this case, it's $50. Now, the one difference that options have that are unique, that are different from other derivatives that we cover, is that it's the right. That is, I get the right to do this, to convert at $50, even if the actual price of the underlying is higher than that, and so that's the $10 profit. But not the obligation. And so if the price of the underlying is actually $40, this would not make sense to me. I wouldn't want to convert. I would lose $10 by converting. I would, convert at $50, but it's only worth $40 trading on the open market. So that would be a $10 loss. It's the right to exercise, but not the obligation. And so in this example, I don't have to, I'm not obliged to make the exercise. I can simply walk away. And in this case, I can avoid that $10 loss. I couldn't do that if it was a futures or a forward or a swap, only with an option. Now I said that this was a call option, and so let's kind of generalize this. We have calls and we have puts. Call is a right, but of course not obligation, to buy at the strike price. But a put is a right, but not the obligation, to sell at the strike price. So with a call, we have the right to buy at the strike, and if the spot or the underlying ends up above the strike, then great, that's a profit. With put, it's a little bit different. If we have a strike that ends up above the spot, that's when we have a profit. Let's put some numbers on this. If our strike is $50 and the underlying subsequently falls to $40, well, we can still sell at that higher price. And effectively, we're sort of buying back at the price in the market of $40 for a $10 profit. It locks in a right to sell at that higher price, this put. So call, we have a right to buy, and so it looks like this. Put, a right to sell, and it looks flipped around like this. And more or less what the call gains, the put loses, and vice versa. Take the example here. Our strike is 50. Have the same strike here for the call. If the spot ends up down to 40, then $40, same here. But look, here we see that the call option loses $10 whenever this put option gains $10. But again, the right, but not the obligation. So there's one more thing that we need to add to this when we're figuring out the gross profit, the profit from a call or a put. And that's the fact that we can walk away. If there's a loss, we just walk away from this option. We're not obliged to incur that loss. So here, yes, this call option here is minus $10 because the strike is above the underlying. It'd be more expensive to convert here than simply buy in the open market. And so if that's a $10 loss and we want to walk away, we just denote that by this zero here. And the way to represent this call option, the payoff of it, is that we're going to take the maximum, whatever larger number this is, either this term right here or zero. Minus $10 or zero, zero is bigger, we go with that. And so that's why for a call option, the profit, the gross profit, not considering transaction costs, not considering the cost of the premium, is the difference between spot minus strike or zero, whichever is larger. And the value for a put option, calculating the payoff for a put option, is pretty similar. Here it's $10. X minus S is $10. And so we'd go with that. But if X, the strike was at 50 and the spot went up to 60, then I wouldn't really enjoy the right to sell at 50 when it's currently selling at 60. That would be a $10 loss. And in that case, I'd walk away from this option. So with a put, it's the maximum of the difference here or zero. So the two are really just kind of inverses of each other. The only thing you need to do is kind of flip this around. One thing I need to note with this is that we have European and American options. These are two different types of options, and they have nothing to do with where they are being traded on the globe. They have everything to do with when this particular option can be converted into the underlying. So with a European option, you can only convert at expiration. This call option, even though the underlying may be infinitely lived, the stock can live for, as long as the company is around, the option on the stock may only last for a month or 6 months or up to 12 months. It's specified in the details of the option contract. But the expiration date, if it's a European option, it can only be converted into the underlying at the expiration date. It can still be sold to another person. The call option can still be sold, or the put option. It's just it can't be converted into the underlying. That's different than a American option. American option, you can convert at any time that you want. In practice, because both of these can be sold on an options exchange at any time before expiration, the value between these two, there's not a huge difference in value. The main difference when the main time in which a value difference occurs between these two different types of options is when there's a big dividend involved. But that's beyond scope for the moment. For now, it's just to know that there's this definitional difference between European and American options. With this defined, whether we're talking about an American or European option, there's something important to describe, And that's this relationship between puts and calls, specifically something called put-call parity. It's a fundamental kind of pricing mechanism in option pricing, and it allows you to figure out the price of a call if you know the detail about the price of a put as well as a few other items. And vice versa, if you can figure out the price of a put if you know the price of a call as well as a number of other items. And the way we can describe this is twofold. There's two strategies that we can trade options with use options to reduce risk in trading in the underlying security, such as a stock. There are actually many different strategies for trading options to reduce risk, but two big ones we can identify here. First is this: we can buy the stock, but we want to reduce risk of owning the stock, and so to do that with a derivative, at the same time when we buy a stock, we can buy a certain amount of puts. A put, remember, locks in the rate at which we can sell the underlying security. And so a put actually makes money if the spot rate ends up falling. If we locked in the right to sell for 50 and the underlying drops down to 30, then here we have a $20 profit. So whenever the underlying falls, the put actually makes money. And the profits from that put will offset any losses from the value of the stock declining on our ownership position of that stock. So this is called a protective put. We're buying protection by buying a put on the underlying security that we already own. And if we want to look at what that looks like graphically in terms of the value of our position, with a value, with a specific strike price specified for this put option, what's going to happen is if that the underlying ends up increasing in value, our underlying position on the stock will also increase in value. But our put will become worthless. We're sort of out the cost of that put. But if the stock instead falls in value at some point, in fact, at the level of the strike price, our stock will fall in value, our stock position will fall in value. But at some point, specifically at the strike price, that put is going to kick in, and the value of that put is going to increase dollar for dollar that the amount of the underlying stock price falls. And so if we size our position right, the value of the stock could basically go to zero, and because we bought a protective put, the value of our overall position, stock and put combined, actually stays flat. And so here, this is why it's called a protective put, because as the underlying falls in value, we've locked in a certain value for our position, these two combined. And yet, if the underlying increases in value, the more it increases, the more we get to enjoy the upside of owning that stock. And the put, remember, we can walk away from the losses. And so, the most we can lose here is zero. Well, really, the most we can lose is the costs that we paid for the put, the premium. But since our losses are capped, our upside is still unlimited. So that's why a protective put is an attractive strategy for risk management here. And yet there's another strategy for risk management. Let's call it long call and risk-free bond. RF stands for risk-free. The name isn't quite as attractive as a protective put, but let's take a look at the payoff profile. Instead of actually buying the stock, I could straight up just buy a call. And that's kind of a leveraged position on the stock. As the stock goes up, the value of the call goes up. But of course, as the stock goes down, the value of the call can go to zero, all the way to zero. And if we look at that on a graph here, let's say that's the value of the underlying, then you can see we have the following, but that's just a long call part of this position. The other is that when we buy a call, we also buy a certain amount of risk-free bonds. So these bonds aren't going to default, they'll earn a certain amount of interest, and what they earn is unrelated to the value of this call position. Because it's not a bond on the stock, it's a bond on, like, say, the US government. So because I have a certain position in an option and a certain position in bonds, if I size this position right, then I can still enjoy the profits if the underlying goes up and the call increases in value. But if the call becomes worthless, my net position of these two securities together doesn't go to zero. Because even though the call may be worthless, I still have an investment, a certain amount of money invested in these risk-free bonds. And so again, if I size it right, the value, regardless of what the stock does, will look something like this. I mean, dependent on what the stock does, really, but this is my payoff profile for this long call and risk-free bond position. And then note how similar that looks for the protective put position. The payoff profiles look exactly the same. And that's the key thing. If you have two payoff profiles that are exactly the same thing, they produce, based on S, the same profit. And since they are both based on S here, the underlying, the same level of risk for the same amount of profit, then they should cost the same. I mean, otherwise, if one were cheaper, everyone would buy that. If these both yielded the same amount of profit, and yet somehow, I don't know, calls were particularly cheap, everyone would just produce this strategy and they would avoid this strategy. But everyone doing that strategy would end up, all that demand would end up pushing the value of the call options up, such that it's no longer cheaper to do this versus this. There's sort of a balancing force between the two based on market forces, based on supply and demand. And so this is where put-call parity starts to matter, because put-call parity says this. It says, if these two things are equal, that buying a position in the underlying, S sub zero, at the beginning of this time period, that's what that means, zero, and buying a protective put, if buying that up front is the same as buying a call right up front, plus a certain amount of position in a risk-free bond, let's call that X, same as the strike price, discounted because that bond yields interest over the life of this position. And that's a key thing, by the way. The position, the expiration date of this put and the expiration date of the call and the maturity of the bond, all these three need to be the same. Otherwise this won't work because they'll differ by other factors. But if they have the same maturity, then this mathematical identity holds. And if you notice that, these things can be identified, this is just a position that we need to figure out, like how much dollars in the bond do we need to put in? And the risk-free rate, that's known. That's just the interest rate on a short-term treasury. And so then if you know the value of the underlying at the beginning of this position, which you can do because that's just the price of, if this is an option on a stock, the price of a stock, then here's the key insight. If you know the value of one of these, if this is known, then the only thing you need to solve for is this. And so if you know the value of a put, you can figure out the value of a call option for the same maturity and for the same underlying security. And likewise, if you know the value of the call, if this is known, then you can use this identity to figure out the value of the put. And the reason why this holds is that there are always people trading in these securities, all of these securities here. And if ever there's an imbalance where one is cheaper than the other, then that imbalance will lead to demand buying in that security, and that will affect the price such that this identity holds. And so this is one way to figure out the price of an option, by a put-call parity identity. Another thing to introduce, a related mechanism for figuring out the price. Option pricing means we're trying to figure out the fair price to pay for an option. That is, what the premium for this particular option should be. Binomial option pricing basically figures out the price or the premium, not by looking at what the premium currently is, but instead by forecasting future outcomes, figuring out the likely outcomes for this stock. And so let's look at just one period ahead, forecast out one period ahead to look at two potential outcomes. One, let's call it outcome good, where the value goes up. Perhaps this is a call. And the other is outcome bad, the value of this value of the stock goes down. And one key element that a binomial option pricing method uses is the historical standard deviation on the stock. Because if you have this scenario versus this scenario here represents, the scenario on the bottom represents a higher standard deviation. There's a greater range of outcomes, both positive and negative, than this example above. And the way we kind of quantify that range, the range of likely outcomes, is by something called standard deviation. The way we look at that standard deviation, we also call that sigma here, is by looking at historically how much has the underlying moved up or down in the past. A higher standard deviation means that the underlying has moved much more than other types of investments historically, both up and down. And so let's take our example here, this example at the top with the smaller standard deviation. We can see we can use this to figure out the price here, let's say, of a call at the beginning. What would be a good premium to pay? Well, it's going to depend on this, what the profit of this call option will be in this good outcome, and what the gross profit of this call option will be in the bad outcome. So just intuitively, you see that what it's worth today is going to be worth, well, if it's good, it's going to be worth that much. If things turned out bad, it's going to be worth that much. And this one here is denoting one step ahead into the future. We're just making a bet, like, one period ahead, 1 month ahead. But the next thing we need to do is kind of quantify what are the chances of that good outcome And we're going to denote that chance by probability here, pi. And if, say, it's a 50% chance here, then therefore there's, the rest of the chance will be that it's a bad outcome, because probability sums up to 100. So with probability pi, it's going to be C1, a good outcome, and the rest of the probability, the rest of the type of events that may happen are 1 minus that. And that's almost it. Like, the price of this call is the chance of it going up by that amount, plus the chance of it going down by that amount. And the only thing that we need to do is realize that these profits here, C1 plus, or the losses, C1 minus, that these don't occur today, but that they occur in the future. And so we have to discount that. Since we're looking at how much we want to pay today, we have to discount it to today's dollars. And discounting by capital T here, that's the expiration date for this option, or really, how far we're forecasting out. So let's put some numbers to this. Here we have our formula, and let's just say these numbers are given. In practice, what we do is we figure out a forecast for these numbers on the basis of historical movements of the stock and options. But for now, just to illustrate, we're trying to figure out the price of the call, and it's going to be based on some chance of it going, say, up by $10. If the price goes up such that the call is profitable, and let's say that we've got a strike of $38 for this call, and if it goes up to 48, that would be a good outcome. If the underlying goes to 48, then you can see that the profit on this is a call. So we take either the difference between the two. If I can buy at 38, sell it at 48, that's great. If I can't, then I walk away. The profit in this up scenario, this good scenario, based on this strike price and what we expect the underlying to do in the good scenario, is $10. So $10 is our C plus here in the future. And let's say we've got a 50% chance of it going up like that. Again, our probability estimates come from historical analysis. And likewise, let's look at the bad outcome. So let's say if the strike goes, the strike is still the same. But if the underlying goes down to $30, then this call is the maximum of either 0 or S minus X. Underlying is S here, so S minus X is the strike, 38 minus $8. And the maximum of these two figures is going to be 0. We walk away in that scenario with 50% chance, 1 minus pi. We walk away. And then we discount it, 1 plus R, whatever the discount is. And for this one period ahead, let's say T is equal to 1. If the interest rate during this time period is, say, 1% total, then that means 1.01. And for one period, so no compounded interest going on or anything, we can take this and then simplify it. 50% chance times $10, that's a $5 weighted profit, and 50% chance of losing or walking away, that's 0.5 times 0 is 0. I'll divide it by 1.01 to bring it back to today's dollars, And voila, we figured out the price of the call. Simplifying a little bit further, that's going to be about $4.95. And that's how you use the binomial option pricing method. That's basically what's going on. The only difference is that in practice, we have longer horizons than just, say, one step ahead. And so when figuring out the fair price to pay today, we extrapolate multiple periods out into the future. And so the binomial option pricing method tends to be a computational exercise. We use computers to actually do these probability and mathematical calculations for us. But regardless, this is the intuition in order to do that. And the math really just follows through too. But here's one other kind of key intuition to pull from this, is that if you have a underlying, and therefore you have a option has a higher standard deviation, a higher, greater amount of ups as well as downs, notice how this will affect the stock price, the value of the call. Because you still have, maybe there's a 50% chance of going to 20 instead of 10, and there's a 50% chance of going down, so you would, have a payoff profile that looks like this, even larger, but you still have this ability to walk away. And because you have that ability to walk away, this part still stays the same, the upside, and the downside doesn't change. You still can walk away. And that's why higher risk stocks tend to have a higher stock price, higher call and put price, more expensive calls and puts. In this example, because of the higher standard deviation, the higher range of outcomes, the call is not $4.95. It goes to, now we have $10, and 0 is still the downside, the maximum loss. And so if we discount that, we see the discounting doesn't change. It's still the same expiration. That gives us a call price of about $9.90. So a higher standard deviation means more expensive options for both calls and for puts. But this is the idea behind the binomial option pricing method. And the binomial option pricing method has been around for a while. It's gotten more sophisticated as computers have gotten more sophisticated, but it's a major approach that people take to figure out the fair price for an option.